Hey everybody, welcome to Korean Atlanta Mentorship. And in this video, we're just going to do another review of the first lien HELOC. So have you ever watched velocity banking videos where they just go, oh, you should just replace your mortgage with a first lien HELOC? And then they're kind of vague about it. Well, I'm going to talk about why, for the most part, it's kind of like burning your money in a trash can, right? Because why put money on the table when you don't have to and give it to the bank? And instead of giving it to the bank, why not just give it to me? Okay, we've done several videos like this before, and we're going to do it again. And we're just going to do it with a lot of income and a lot of expenses. These velocity banking videos actually make more sense when you're dealing with a lot of income because velocity banking is not an income generation strategy, it's a cash flow and debt management strategy. Okay, so we're going to assume we have the 10 credit cards, a nice auto loan, a $200,000 student loan, and a $850,000 mortgage. And if we actually sum this all up, this is $167,000 of credit card debt. um, the total debt amount is 1.272 million. Okay, so let's assume that for whatever reason our home is valued about like more than $1 million. Maybe we got $1.3 million of equity, and the bank says, okay, we'll do a first um, lien HELOC to replace your mortgage, and then we'll let you borrow up to like 1.3 million or something like that. Okay, so let's just do this here, and actually should be 1.3. And so one of the things that we do with velocity banking is we do debt consolidation in order to increase our cash flow. Okay, but there's going to be an optimal way to do that, and that's like one of the most important parts. Like step one is getting what you call a line of credit. And so what's a line of credit? All it is a financial tool where you could borrow money, pay it back, and use it over and over again. And one of the most popular banking products out there is called a home equity line of credit, meaning if you have something called home equity, you could offer it to the bank as collateral and they let you use it like a credit card. Okay, that's what home equity line of credit is. Now I get it. Not a lot of people will have like a $1.3 million home equity line of credit available to it, but just play with me here, right? Because I got, it. This depends on your financial situation, but even at lower and lower levels, you kind of see, hey, like maybe this isn't a smart idea to do a first lien HELOC mortgage replacement, and I have a first lien HELOC, right? But the thing is, I paid off my mortgage first, then I got the first lien HELOC. So here we're just going to pretend we got a $1.3 million line of credit available. Okay. Again, I know for a lot of you, it's like, this is not realistic, but sometimes it's not about whether it's realistic or not. It's about doing the exercise and understanding the principles, right? All you got to do is, if you want to make it realistic, take out some of these zeros, right? So let's go ahead and do this. And we're going to assume the same income, same expenses, right? And then we're going to do income minus expenses as our cash flow, okay? Now, what people say to do on the internet is like, hey, just replace all your debt with that first lien HELOC. Now, this definitely makes sense for like the high interest rate credit cards, right? But does it make sense for like a mortgage that's at 3%? Okay, so let's go ahead and move all of that debt, which is going to be 1.272 million, right? So let's go ahead and do that. So 1,272,000. And actually, let me just, before I do this, let me just verify these numbers. So the credit card is 5 plus 8 plus 15 plus 27 plus 30 plus 7 plus 10 plus 35 plus 12 plus 18. That's $167,000 of credit card debt. And now let's add 55 in the auto loan plus 200 in the student loan plus 850 in the mortgage. Yep, 1.272 million. Okay, so let's go ahead and do this. And we now, by doing a simple debt transfer, guess what? All these payments just go away. Okay, 0, 0, 0, 0, 0, 0, 0, 0, 0. So now we got our food, gas, insurance, our expenses that are always there, because the whole point of this is to eliminate the debt and to increase our cash flow. And look at that. That's not that bad. $12,500 of cash flow, but this is cash flow before the interest on using our line of credit, okay? And so if we have a, let's say a 10% home equity line of credit, which is typical, like I got 8 on from a credit union, but before I had a 10% with the regional bank. Okay, so in a 1.2 million balance, it's going to be quite difficult to see how much interest, um, like, okay, let me rephrase this. It's going to be quite difficult to imagine that we're going to save a lot of money on a $1.2 million balance home 10% home equity line of credit. But let's do the math, okay? So to get the next month's balance, it's the previous month's balance plus the previous month's interest minus our $12,500 cash flow. That's a really good cash flow. But again, it's a really good cash flow on a $1.2 million home balance on a home equity line of credit, which seems to me insane. All right, so it's to get the interest, which is based on the average daily balance. We're going to multiply it by the interest rate, 0.1, 10%, and then we divide it by 12, okay? So now you can see that what I'm talking about, right? So we have this $12,500 cash flow, but $10,000 goes to interest. That is insane. Holy, okay. So let's just do this. I'm going to copy and paste these formulas, and I'm trying to come up with a catchphrase. I was thinking, man, maybe should I say holy balls? Because holy balls, right? So let's go ahead and do that and see how long it takes to pay off this home equity line of credit. Okay. And so now, as you can see, the debt's now getting reduced pretty quickly. And then we'll say it takes about 200, okay. I'm sorry. So 223 months. We'll say it, we'll mark that as our milestone, and let's sum up the total interest. So I'm going to go here somewhere, whoopsie, here. All right, and see how long it takes. So 223 months and $1.5 million of debt or interest. Huh. Okay, so let's go ahead and record these two numbers. See? Oh, what am I doing? So 223, so 223 months, 1.5 million interest. So let me copy and paste that. Okay. So this is what happens with mortgage replacement, and then we'll also compare the difference between not replacing your mortgage. Ooh, but that's a lot of interest. 1 point something million. That's a no bueno. I can't believe it. Can you believe it? Man, I can't believe it. Goodness. Okay, so let's go back here and redo this and all this stuff. And let me go up here. Okay, so for the purposes of example, if we're not doing a mortgage replacement, we don't have to have a huge line of credit, right? Like that's not necessary. I would say probably only a $200,000 limit is necessary, but let's just kind of leave it here as is. And what we're going to do is we're going to leave our amortized loans alone and first start off with the credit card. So we see here that if we move the credit cards, okay, these all go to zero, and our cash flow is $5,413, and our balance in the line of credit is just going to be, instead of 1.2 million, $167,000, right? And then our cash flow will be 5413.68, okay? And then now let's go ahead and copy and paste, and we'll see how long it takes us to pay off all the credit cards. And we see that it took us, okay, yeah, it took us about 36 months. Pretty good, 36 months. So let's go here and mark this down, and also the amount of interest that we paid. So let me go ahead and sum this up. I'm going to do this. I'm going to sum it up. So 36 months and 25.7 grand. Okay, excellent. So here, if we're not replacing the mortgage, so 36, so credit cards, 36 months and 25.6K interest. Okay, so we gotcha, we got that. And then we're going to scroll all the way down. And now, all right. So what do we do now? Now we have to update our loan figures. Auto student mortgage. So give me one moment to see if everything's set up. Okay, so I think we got everything set up here. Auto loan, student loan, mortgage. So all we have to do is type in the current month, and we are now at month 36. So I just type in 36 here. Okay, and whoopsie, I screwed this up. So 36, 36, 36, and it's going to tell us, hey, like, what's the current balance and what's the current what we call cash flow index, right? So what is the cash flow index? All it is a ranking system or indicator of how much cash flow your debt sucks up. So the lower the balance, I'm sorry, the lower the cash flow index, that's the one you want to pay off first, okay? Because in order for us to get $3,500 of cash flow, we have to pay $795,000 to the bank or whoever, right? So let's go ahead and pay this off. I'm gonna go ahead and move this over here, right? We're gonna move this over here, and then I'm gonna copy and paste. So that's plus 25157.77, right? And we did that. Okay, that's cool. And now, guess what happens to this auto loan? Whoa, it turns to zero, right? And so what's our new cash flow? It's $6,489.82. Okay, so let me go ahead and copy and paste that. And then we're going to do right here. Okay, copy and paste this. And paste this. Okay, so that's minus 6489.82. Okay, now let's keep copy and pasting that. And we see, whoa, it took us, all right, so 1, 2, 3, 40 months? Wow, that's amazing. That's pretty, it's pretty spot on. Okay, so how much interest did we pay to use that line of credit? Uh, so it's basically, it's not that much. A couple $100. 1, 2, 3, 4. I think we already counted this interest. So let me go ahead and sum this up. So equals sum H37, 38, no, 30 and 39 to H4, I believe, I think, or 42. All right, so about $343, okay? So 343, that's such little interest. So car, okay, so 343 plus, but we have to take into account the previous interest that we had already paid. 7,000. Okay, so I'm copy and paste that. Okay. So the car, the interest on that is 8241.74, right? 821.14, I don't even know what I'm saying. 8241.74, that's the interest. And then the number of months it took, we'll just do the total number of months, it'll be easier. 40 months, 40 months. So 40 months in total. Okay, 40 months. But we'll do the interest separately. Okay, so now we've done that. Okay, so we've done the credit card, now we've done the car, now we got to do the student loan. Okay, the student loan, $200,000, and now we're at 40 months. So this is now 0. This is now 40, 40. Oopsie, 40. And $150,000 is left in our student loan balance. Okay, now should we replace this to the line of credit? I don't think we should. We'll just probably do what we call the chunking method, because again, take a look at the CFI. Higher than 50, lower than 50 you want to pay off. Higher than 50 is and then higher than 100, we definitely want to use the chunking method. We don't need to replace our mortgage, and we have a velocity banking calculator to help us determine the debt payoff. So give us one moment. I'm going to open it up. All right, so I do have the velocity banking calculator ready. So let me switch gears or switch windows, and then you just fill in the information, how much you're moving to the line of credit, what we call the chunk amount. And I just want to do a quick test, right? So I know this is an 8% student loan and a 10% line of credit interest rate. I don't know if it's going to make that big of a difference, but let's just check. So if we move 15,000 chunks to the line of credit, we see it gets paid off in 1.5 years, and it's only about $9,600 in interest. But what if we replaced it? How much difference would that make? About 2 grand more. Okay, not bad, right? So let's just do this 1.5 years and then 9.6 grand. So let me go back here to the other section, to the other, all right. All right, so this is now 0. Okay, and let's just go in here. So it's the student loan. So the student loan took, let me take a quick look at my spreadsheet, 1.5 years plus 40 months. So I gotta turn 1.5 equals 1.5 times 12 plus 40. Okay, so 58 months, and we have to actually take a look at how much interest we paid at the 40 months right here. So that's about 47 grand. Okay, so 47 grand, and then once we did the chunking, then we paid 9.6 grand. Okay, so let me just do this. Equals plus 9,600, right? And so that's 56.7K. Okay, so we'll just do 56.7K, right? All right, so we got that. And then same thing with the mortgage. You just fill it in the velocity banking calculator. So let me just kind of redo my calculator here. Give me one moment. Okay, so I filled out all the information with the mortgage. So the current balance is $759,000 and 80 cents at 58 months, and just fill it in. And you can see how much money we save at 3%, even though it's a 10% line of credit. Now, here's the other thing. Let's go ahead and do a mortgage replacement of this, even at this stage, and see what happens. What? We only saved $9,000? Whoa, right? Like, this is insane. This is why, like, what are you talking about? Yeah, sure. Like, here's the thing. If I were the lender, right, and you told me, yeah, I was expected to make $323,000 of interest over a 30-year or 20-something year period or whatever, I would have been like, man, that's cool. But if you could speed that up, yeah, I'd give up 9 grand to speed it up. You know what I mean? So this is actually preferable to the lender. At least if I were the lender, I would think that, right? Wait 7 years, get most of the interest back, and only shave off 9 grand. Why not? And then I'll just make another loan off of that. But if we only just kind of do a small amount, we can save 253 grand, right? Even at a 3% interest rate with a 10% line of credit. Okay, so let's go ahead and copy these figures. So it's going to take 5.6 years to pay off that mortgage. And let me go ahead and switch gears here. So this is where we're at, 58 months. We paid 116 grand in interest. And then so now we just add a 70 grand on that. So 70 months. No, wait, 70 grand. So it goes 116 plus 70. That's 186K of interest. Okay. 186K of interest plus, how much time? Let me go back to my other sheet. 5.6 years. So 186K of interest and 5.6 years. Okay. So let me go back here and let's just do this. Okay. So 5.6 plus 58. So we just do the math. So 58 divided by 12 plus 5.6. That's going to be 10.4 years. Okay, so 10.4. So time frame is going to equal 10.4 years to pay off all of our debt. Not bad. And let's just calculate the interest. So it's going to do this. Mortgage. Okay, so total is going to be 10.4. Oh, I'm just mixing this up. Let me just do this. So total will be 10.4 years. Now we have to, I know this is a little bit confusing where I summed up the time but did the interest individually, but it's okay. So it'd be 25.6 plus 8,200 plus, and I'm just estimating here, 56, well that'd be 8.2, wouldn't it? Yeah, 8.2 plus 56.7 plus 186, okay? And now let's go ahead and sum that up. So that's interest is 276.5. So interest equals 276.5K. All right, so now, okay, so now let's just kind of do I guess a difference in the for the how much is it in the for the replacement? It's 223. Well, let's do this. 223 divided by 12. And so that's 18.58 years. Oh my goodness. 18.58 years, right? And how much interest are, oh my goodness. 1.5 million. And so I don't even know what to say. This is just like burning both, like wasting time and money. Okay? Like I know some of you think, "Oh my goodness, I need to replace my mortgage with the first lien HELOC." And it's like, "Are you insane? Are you insane?" Okay? So what's the actual time difference? So that's 18.58 minus 10.4. So you save 8 years. So save 8.18 years. And in interest, it'll be 1500000, okay, minus 276.5 or 276,500, okay? So that would be save 1.22 save 1.22, oh geez, million. Oh my goodness. You see that? Like I don't know if this is why I kind of emphasize doing with large numbers, because the difference becomes much more apparent with larger numbers. But holy balls, like if I'm gonna save or if I'm gonna replace my entire mortgage with the line of credit and do all these other ones, I'm just kind of throwing money away and burning it in the trash can. And here's the thing, if you're thinking about doing this, just give the 1.2 million to me. Like don't give it to the bank. Don't pay all that interest. That's insane. Don't no, give it to me. Give it to me. Okay? Like you don't need to pay this 1.2. Like I can't even believe what I'm here like seeing. You know what I mean? Like that is insane. Like oh my god, like this is the one where I'm just kind of like disgusted now. Are you disgusted that people teach this online? to just replace your mortgage to home equity line of credit and not like just kind of do a basic math. 1.2 million. Holy balls. All right. Well, that's it for today, everybody. Have a great day, and we will speak next time. This is Korean Atlanta Mentorship.